Hello everyone! Welcome to the Value Pie channel. I'm Elaine. Today, let's spend 15 minutes talking about a highly controversial company, Pinduoduo. Back in 2018, when Pinduoduo went public, the fund I was with hesitated over whether to subscribe. Looking back, even now, it's clear that many people still don't truly understand the company. We'll once again use a mind map to break down Pinduoduo's business model by analyzing the core beliefs of its founder and leadership team. We'll also analyze how its current performance aligns with long-term goals. Since its precursor, Pinhaohuo, Pinduoduo has followed a core strategy, offering a limited number of SKUs while prioritizing user retention and repeat purchases. When Pinhaohuo launched in 2015, it sold only 20 to 30 types of fruit at a time, yet each SKU reached nearly 30,000 daily orders. A dedicated team of buyers traveled across farms nationwide, leveraging economies of scale to drive down costs. This strategy was a sharp contrast to Taobao's GMV-driven, search-first model, which thrives on massive SKU volume and long-tail demand. Instead, Pinhaohuo, and later Pinduoduo, focused on boosting repurchase rates over GMV. Pinduoduo refined this with a curated but diversified recommendation engine. Once a product hit scale, the platform activated a consumer-to-manufacturer (C2M) model to slash costs. This strategy is similar to the difference between Walmart and Costco. Let's break it down across three key dimensions: SKU count, pricing, and gross margin. First, as platforms, both Pinduoduo and Taobao naturally have a higher number of SKUs compared to non-platform retailers, especially inventory-heavy retailers like Costco. However, if we use SKU count as the x-axis, Pinduoduo has fewer SKUs than Walmart and far fewer than Taobao. As Pinduoduo is known for its low prices, many people tend to associate it with dollar stores like Dollar Tree. But let's take a closer look at the difference between Costco and a dollar store. Costco offers a curated selection of SKUs in bulk packaging, attracting relatively affluent consumers with low margins. Membership fees account for over 60% of its total profit. High-quality SKUs ensure high repurchase and turnover rates, which in turn drive down costs. In contrast, dollar stores attract customers with ultra-low prices, but rely on high-margin SKUs to sustain profits. If we use the y-axis to represent product price, Costco sits at the top due to its bulk packaging, while dollar stores at the bottom. Pinduoduo's product pricing falls in between. However, if the y-axis represents product gross margin, the picture flips entirely. Costco has the lowest margins around 10% to 15%, while dollar stores have the highest, can be as high as 50% to 70%. Pinduoduo's products also carry significantly lower gross margins compared to Taobao. Early on, Pinduoduo faced intense skepticism. Could it sustain ultra-low prices while managing logistics costs? Was its model too easy to copy? So let's use a mind map to explore how Pinduoduo achieved remarkable growth and profitability despite its low-price model and added logistics costs. What exactly is Pinduoduo's moat? First, Pinduoduo wasn't built by trial and error. It was a top-down, deliberate design. Unlike traditional e-commerce that grew organically, Colin Huang and his team used their deep understanding of supply chains, consumer behavior, and platform ops to craft a model from day one, and executed it with precision to scale fast. Pinduoduo's rise was insanely fast even by global standards. Microsoft took 25 years to hit a 100B valuation, Alibaba 15, Meta 10, Google 7, and Pinduoduo did it in just 5. It moved so quickly that the market couldn't react, and investors didn't even have time to back a serious copycat. Second, Pinduoduo built two powerful flywheels, one on the consumer demand side and one on the supply side. Pinduoduo's founding team had experience in both e-commerce and game development. After his first startup success, Colin Huang founded Leishi in 2010 to help brands sell on e-commerce platforms. But seeing limited upside, part of the team pivoted in 2013 to launch Junmeng, a game development company. In 2015, Colin Huang started Pinhaohuo, which took off quickly. Later that year, Junmeng's CEO suggested turning the group buying model into a full platform. Pinduoduo was born. They pulled in their top 20 team members and reinvested their game profits into the new venture. Because of its gaming roots, Pinduoduo approaches consumer insight more like a game company. Traditional marketing segments users by income, interests, or location, and offers different products accordingly. It works, but it's not bulletproof. Plus, low prices and group buying had been tried by other e-commerce players before, and none really made it work. Consumers are incredibly smart. Price differences eventually get noticed, and once they do, people will bargain hard and brand loyalty takes a hit. It's also harder to serve every segment. Nokia needed dozens of models to stay relevant. Apple did it with one. That's the difference. Pinduoduo is going after a mindset. These are value-conscious users who might buy a Hermes bag, but are also happy to buy a box of mangoes for 9.9 yuan. The goal is to meet people's different needs in different scenarios. Pinduoduo treats products like game mechanics, constantly tweaking user interaction and adding new play. Search is downplayed. The homepage runs on algorithmic recommendations. Features like lucky draws and red envelopes tap into emotional, even playful parts of shopping. Early on, it grew fast through WeChat sharing and group buys. Over time, smarter algorithms helped it build its own ecosystem and move beyond WeChat. Pinduoduo leans into fast-moving categories like apparel, groceries, and agri-products to drive repeat purchases and build loyalty. Taobao leans toward household items and electronics. JD is heavily skewed toward electronics, while short video platforms like Kuaishou and Douyin focus more on apparel. Since 2020, internet user growth in China has slowed, and platforms like Taobao and JD.com have hit their ceiling, driving up user acquisition costs. The old traffic-driven GMV model doesn't work like it used to. As Colin Huang put it, Tencent had the most traffic and backed tons of e-commerce startups. If traffic were all that mattered, it would have won long ago. GMV is essentially traffic times conversion rate. To keep growing, platforms need more than just new users. They've got two main levers: boost conversion and get more GMV from existing users through repeat purchases or higher order value. But as Taobao and JD.com have shown, raising order value is hard, limited by user habits, spending power, and what's being sold. So in the long run, it's conversion and repeat rate that really move the needle. Taobao and Tmu's algorithms are GMV-driven, so they prioritize higher-ticket items like Dyson hairdryers, even if the conversion rate is just 3%. Pinduoduo, on the other hand, optimizes for conversion, favoring products that more people will actually buy, like unbranded hairdryers with much lower prices, but a 15% conversion rate. Lastly, Pinduoduo attracts consumers in China with its 10 billion yuan subsidy and builds global credibility through its IPO, expansion into North America, and major ad placements in Super Bowl. This has helped accelerate its global push, especially in Latin America and Asia. This created a strong flywheel on the consumer side. Pinduoduo's annual orders per user jumped from 17.5 in 2017 to 115.1 in 2023, nearly a 6x increase, with users placing an order every 3 days on average. In comparison, Alibaba and JD.com are estimated at 52 and 14 orders per year, respectively. A successful e-commerce platform also needs to attract merchants. For more in-depth analysis and insights, please subscribe to our channel using the link above. Thank you!